So we'll try to design a mutual funds portfolio. Okay, in this video series we will discuss how to design a mutual fund portfolio. Okay? So in this section we'll discuss allocations. So allocations is a part of a mutual funds portfolio, and we will discuss allocations here. Okay, and I'm Sarwan Agrawal. The intent here is to show a do-it-yourselfer to put together a decent portfolio. Okay? Nothing exciting, nothing exceptional, but a decent portfolio. Okay, let's continue here, and we will go. Let's continue. Okay, so that's where in this section we'll talk about how to put together a decent mutual funds portfolio. Okay, and in this section we'll discuss allocations only. Discuss allocations. Okay, let's continue here. Let's continue. We'll go through the outline here. First section is allocation. We'll talk about allocation is what the constituents are. Okay, what the components of allocation are. Okay, and then I will do active. What's this passive portfolio? Some description on what's active, what's passive. Okay, and then we'll study some sample model portfolios, both active and passive kind, from online. Then we'll look at build a passive portfolio. Okay, we will build a passive portfolio. Then we'll do a select funds. For active portfolio, we need to select some funds. We are going to populate a portfolio with. Then build an active portfolio. Okay, then we'll work out example, 60-40 example. Okay, and then we'll how do an engineer designs a portfolio. Okay, then I'll go over how I do a portfolio and show you a 60-40 portfolio I would design. So allocation, an investor needs to decide on allocation, okay, which is based on risk tolerance and time horizon. Okay, let's continue here. A basic portfolio consists of two components: stocks, which are also called equities, and bonds, which is also called debt. Okay, let's continue here. And the properties of these two components is a higher allocation to equities, which is the stocks here. Stock funds, and stock ETF is generally more volatile. Okay, a risk is higher, volatile is risk is higher, and returns so are. Let's continue here. Some portfolios also have exposure to alternatives like real estate investment trust, precious metals, managed futures, market neutral strategies, hedging strategies, and some more stuff. Okay, and some advisors also love to use exotic assets like EMBB, which is emerging markets beyond BRICS. Okay, this is the newest ETF that shows up, and this advisor wish to incorporate that in. Let's continue here. Okay. In my opinion, that's like a child wish to have the latest toy. So a newest toy shows up, a newest ETF shows up, and kids want the newest toy, and so some advisors love to have that in the portfolio. Okay, let's continue. That's my opinion. I stick to the basics, okay, which is stocks, US and non-US, usually developed countries. Bonds, total return, usually US. Then option real estate investment trust. I usually don't use the real estate investment trust. And optionally high yield bonds. I have used those high yield bonds. Okay. Now we look for risk return trade-offs. Okay. Bonds are less volatile, and stocks usually outperform bonds and have a higher volatility standard deviation. Risk is higher for the equity stocks, and so is the returns are higher. And for bonds, returns are lower, and so is the risk. Okay. Let's continue here. Because this conflict, it must be possible to design a portfolio with a decent return at acceptable risk, which is a standard deviation. Okay, let's continue here. For that, we are to figure out a decent trade-offs. We will look at some chart here. We're considering a chart and a table shown in the following pages. Okay, continue here. And I use this tool Easy Backtest to draw charts and also performance data. You can download the tool from this website easy-backtest.blogspot.com. Okay. On that site, you download. There is a chart of returns versus risk. Okay. Okay. And this is a 10-year data as of 14th July 2014, when I have 0% stocks, and this is the 100% stocks. So as I go from 0% stocks to 100% stocks, my risk goes up, and so do my returns go up. Okay, let's continue here. Let's see the same. Here's the table for 10-year results done on 14 July 2014. I increase the stock percentage from 0 to 100, and that also means I reduce the bond allocation from 100 to a 0. Okay, and this is the least standard deviation. 3.24 and 3.25 are about similar values. So least standard deviation happen at a stock allocation of 5%, and the return is 5.20%. Standard deviation is 3.25. Fourth column is for Sharpe ratio, and fifth is for DQ, and highest Sharpe ratio is for the 10% stock allocation, and for the same allocation of stocks, highest DQ is also highest. Okay. Here's the 20% portfolio here. This portfolio, I read someplace in a portfolio book, is that is least likely to lose money in any year, any calendar year. And for 20% allocation, I can still get a 5.92% per year return based on a 10-year growth chart, and standard deviation was 4.16%. Okay. And 40% allocation of stocks, return is still higher than the standard deviation. Okay, and when you go further up, more allocations, returns go up, and so do the standard deviation, and standard deviation go up a lot faster. Okay, let's continue here. So STD is standard deviation on the previous charts. Okay. Stocks consist of two funds: Vanguard Total Stock Market Fund, which is the US part, and Vanguard Total International Stock Fund, which is non-US. Okay. And bonds consist of Vanguard Total Bond Fund, and such that Vanguard Total Stock Market Fund ratio of US funds to non-US is 2 to 1. So I have twice as much of total stock market fund as I do a total international stock fund. Okay, let's continue. DQ is desirability quotient given by the ratio return over standard deviation. High returns are better and lower standard deviation is better. So if I'm trying to seek a maximum of this ratio, return over standard deviation. So my desirability quotient is this ratio here. You may not find that book in a finance book. You may not find DQ specified in a finance book. It's a term defined and used only in this presentation. If I can make up a term or a ratio or a stats, so can you. If you need a reason to compare some non-standard ratios or non-standard value, you can define your own, okay, and use that. Let's continue. Let's continue. Observations. We already noted these observations before from the table. Least standard deviation is for a 5% stock allocation. Okay. And for least standard deviation, return was 5.20% per year in that table. Okay. And for 20% stock allocation, which is allocation a portfolio is least likely to lose money in any year, is 5.92% per year. For 60% stock portfolio, which is a classical 60-40 portfolio, return was 7.42% per year. That's the data from the table we had in the previous pages. Okay, And maximum Sharpe ratio was for a 10% stock portfolio. And maximum DQ was also for the 10% stock portfolio. Okay, let's continue here. And 40% stock at 40% put stocks, return was higher than standard deviation. And when I go up in stocks, returns and standard deviation both go up, but return becomes lower than standard deviation. Continue. Note, the above represents stats for a passive portfolio. A well-designed active portfolio should deliver high returns or lower standard deviation or both A and B. So should return high returns at same or lower standard deviation or return lower standard deviation for same or high return or return both. Okay? So this is what we're trying to do. We're trying to get return. A well-designed active portfolio should deliver high returns and lower standard deviation. Okay? At least it try to deliver that. Continue. Let's look at allocations. Why this allocation is so important? Why is allocation so important? I have heard that 90% of the returns are attributed to the allocation. Okay, somehow it does not talk anything about the risks, standard deviation. Okay, returns are attributed to the allocation. In spite of that, most advisors do not use index fund ETFs to achieve a target allocation, and some do. Okay, let's continue.